we always said the market bottom will be when the generals, quote unquote, get shot. And it looks like the generals have been shot. I think the stock market is going up.
Billionaire Chamath Palihapitiya helped take SoFi public in June 2021, launching the formerly obscure student loan startup into the public investing eye. And here's why SoFi might be one of the best investments you could make right now, with their members up 61% while making more money than ever in their latest quarterly earnings, while SoFi's stock price is still hovering around their book value of $5.50. Despite their rapid growth, I see an amazing opportunity to take advantage of an undervalued company that's taking over the fintech space. Kind of like this photo of Elon Musk carrying a sink is an undervalued meme template. Come on, there's so much potential there. So in this video, I'll look at several catalysts in SoFi's near-term future that could provide a significant boost to the stock price, go over what Chamath's comments on the market mean for SoFi's future, and look into some interesting data buried in SoFi's latest earnings call that the market may be missing, which could provide another opportunity for investors to make some money. And if you want to stay updated on SoFi or investing in general, make sure to subscribe below. So SoFi just reported earnings for Q3 2022, and in that earnings call, the CEO called out 3 catalysts that could benefit SoFi going forward. So to start with the short-term catalysts, SoFi is going to benefit from high interest rates. SoFi's business is a little unique when compared to competitors like Robinhood, which is known for its investing platform. Because while SoFi does offer financial services like trading stocks in the SoFi app or using a SoFi credit card, they use these services to attract their initial customers, then upsell them into more valuable parts of the SoFi ecosystem. Kind of like when you go in for an oil change on your car and they always find a million other things to sell you. The most valuable part of SoFi's business isn't actually their app at all, it's lending. SoFi actually started out as a purely student loan business at Stanford Business School before later building on their other businesses like their technology platform and their financial services app. And this gives them a pretty major competitive advantage when we see interest rates rising like they are right now. Because you may have noticed prices have been increasing a lot lately. My personal favorite measure is the Chipotle Burrito Index, which shows inflation is off the charts. But as much as rising costs hurts as a consumer, inflation is actually a really good thing if you're a bank like SoFi. I won't get into the super specifics here, but SoFi can, at will, lend new money at a higher interest rate while themselves leveraging old money at a lower interest rate, effectively letting them earn the spread in those two different interest rates. The higher the rate hikes, the better the spread that they can pocket. In this article, which I reviewed in a previous video, an analyst points out how a 1% rise in interest rates grows companies like Charles Schwab's net revenue by 6.2%. This has many analysts predicting SoFi's net interest income will jump from the $252 million they made last year to $703 million in 2023, more than a 3x increase. And this growth rate in interest income is also notably a lot higher than SoFi's own forecast, meaning the market may be surprised when SoFi reports better than expected earnings next year, resulting in a nice boost to the stock price. But that's not even the biggest catalyst that they'll see over the next few months. The second short-term catalyst is the end of the federal moratorium on student loan payments. Anyone who's been to college in the US probably has student loans, and they also probably know that the US federal government has paused all payments on federally owned student loans for basically the past 3 years. But that pause is now ending, and that is a huge deal for SoFi. Before COVID, SoFi serviced around 70% of the student loan market, a market which all but dried up over the past few years. Now that doesn't sound like a good thing for SoFi, and it wasn't, but SoFi was able to divert disaster by quickly pivoting their lending business into other loan markets like personal loans, which we can see in their latest earnings release makes up the bulk of their originations today. But with the student loan pause ending, all that lending business is going to come roaring back to life. And let's walk through how big this could actually be for SoFi. If the company can increase their current $3.3 billion in student loan originations back to the $8 or $9 billion they saw back in 2019, that could double their lending segment revenue. And I think that's a pretty reasonable consumption considering SoFi's average student loan borrower makes too much money to qualify for any form of student loan forgiveness. So if we look at that in terms of profit, it would take them from around $450 million per year currently to nearly $1 billion per year in adjusted profits, a more than doubling. Pretty good for a company that's currently trading at a $5 billion valuation. Now you can argue that adjusted numbers don't include expenses like stock-based compensation, which is important to recognize. But regardless, this is still probably the single biggest catalyst that SoFi will see in the short term. But for the third and last catalyst, we need to look out a little longer to the 5+ years in the future timeline, because that's where SoFi's real potential lies. While traditional banks have continued to shed market share year after year as people flee their high fees, low APYs, and poor service, SoFi is gaining market share like a hamster eating carrots. And if you haven't seen a hamster eating carrots, it's really adorably fast. Let's just take one service as an example for now, since we'll be going into their earnings detail in a little bit more detail in a minute. Looking at SoFi Money, which includes the SoFi checking and savings account, SoFi managed to grow their number of members by 72% while maintaining an average FICO score of 750. And 85% of their deposits came from direct deposit customers, meaning they'll probably be sticking around for a while. That also means SoFi Money is growing faster than 99% of banks out there, while the rest of the banking world is struggling. So why might that be? Well, maybe it's because SoFi offers a checking and savings APY 62 times greater than average, or maybe it's because they're smart marketing to millennials and Gen Z, or maybe it's because SoFi has an ecosystem of products that work better together, drawing in users and then cross-selling them with more and more valuable services that give their customers value. Whatever the reason, the numbers don't lie, and they show that in the long term, there will be a continued trend of customers away from traditional banks and into nimbler digital-first companies. SoFi is just one of those digital banks, but in my opinion, it's one of the best positioned to benefit from this trend, something Chamath clearly saw when he first took SoFi public. But as important as it is to analyze the trends behind stocks, it's just as important to have an investing platform that gives you the tools you need to be successful. This video's sponsor, MooMoo, is a commission-free trading platform that makes it easy for traders to do everything they need, from charting and trading stocks to connecting with other traders to investing in ETFs or options. Plus, when you sign up for MooMoo, you can get up to 15 free stocks, and using my exclusive link below, when you deposit even $1, you get an extra $10 coupon for a limited time. MooMoo is owned by Futu, a NASDAQ-listed fintech company that's been in the industry for the past 10 years with over 19 million users. With MooMoo, you can trade like a pro with professional-grade tools, but you also get an easy-to-understand consumer-level interface. They can help you monitor market movements, perform deep technical analysis, set up a screener to filter for stocks that meet certain criteria, and they even provide a community that you can bounce ideas off of. If you're just starting investing or want to try a new strategy, you can also use MooMoo to paper trade stocks. Just sign up for a paper trading account to practice investing without putting real money on the line, and you can build your skills by taking one of MooMoo's investing courses or by just learning from other investors on the app. Or here's a cool feature, you can use MooMoo's heat map to show at a glance how different parts of the market are performing. MooMoo is the most advanced free trading app that integrates AI-powered tools, comprehensive real-time data, and an engaged investing community. I personally like tracking the trades of big investors like Warren Buffett, and you can do that from within MooMoo. If you open up the Markets tab and scroll down, you can see institutional investors such as Warren Buffett's Berkshire Hathaway. If you open that, you can see what industries they are investing in by percentage. Scroll down to see the individual stocks, and of course, click into the companies to see even more details. And right now, MooMoo is offering the chance to win up to 15 free stocks, and by using my exclusive link below, when you deposit $1, you can get an extra $10 in cash for a limited time. So check out MooMoo using the link below, and let's now turn our attention to SoFi's stock price, specifically the comments by Chamath Palihapitiya. So in a recent podcast, Chamath talked about his thoughts on the stock market in general, saying he thinks we have already seen and moved past the market bottom.
When everybody talks about being long the S&P 500, it was always really a proxy for being long Amazon, Facebook, Google, Microsoft, and Apple. And at the peak, in May of this year, it was still 25 cents of every single dollar of the S&P 500 were these 5 companies. And, we always said the market bottom will be when the generals, quote unquote, get shot. And it looks like the generals have been shot. And what's incredible is this week, every single one of those companies, other than Apple really, reported pretty crappy earnings. They got totally taken to the woodshed.
So if the largest companies in the S&P 500 are now seeing their stock prices tumble, it may mean there are no more sellers in the market, and we will see a rebound from here. That is especially important when we look at small growth stocks like SoFi, since their valuation depends so heavily on how much the market weights the value of their future earnings. SoFi currently trades at a price to sales ratio of less than 4, meaning the market cap value of the entire company is less than 4 years worth of their current earnings. At this price, the market is almost completely discounting the value of SoFi's growth rate and future earnings. After all, the company is growing revenue at 50% year over year, and yet the market cap is trading at basically the book value of the company, meaning if you broke SoFi up and sold it off for scraps, it would be worth worth about the same as it is right now operating as a company that's performing well by most metrics. And that seems like a potential opportunity. So if the market begins to reverse course and give companies like SoFi a higher price to sales ratio, that's money in the pockets of SoFi investors. But it's all well and good to try to predict the market's next move over the next few months. But it's way more valuable to understand how a company is actually performing before investing in it. So let's now take a look at why SoFi's stock price jumped 20% in a matter of hours after the latest earnings, before giving up some of those gains after that. I mentioned earlier SoFi has three main businesses rolled into one. There's their financial services, their lending business, and their technology platform. Sort of the holy trinity of companies. So let's step through each business and build our way up to understanding SoFi's entire business. Starting with financial services, which mainly includes the SoFi app. SoFi sold 5.9 million products this quarter, up 83% year over year. They also saw their number of members increase 61% year over year to 4.7 million this quarter. That is pretty insane growth for an already large app user base. And this segment then acted like a sales funnel, flowing customers into SoFi's real money-making business, which is lending. The lending segment saw a more moderate 24% growth in products sold this quarter, but they also saw contribution profit of $180 million in this quarter alone. And these lending numbers on screen are in the thousands, by the way. And because SoFi's customers tend to be very high-income individuals with FICO scores in the high 700s, a SoFi app customer that later becomes a lending customer makes SoFi twice as much money on average as a customer who just goes straight into lending. This shows how SoFi's financial services productivity loop is making each new customer they acquire more profitable than the last. And then lastly, we have SoFi's most overlooked but probably most impactful segment going forward, their technology platform. The technology platform is a mixture of two separate billion-dollar acquisitions SoFi made, Galileo and Technisys, which together make up the tech backbone of SoFi's platform. The goal for this platform is to become the AWS of fintechs. Similar to how a big chunk of the internet runs on Amazon Web Services, the US's financial infrastructure could run on SoFi's technology backend. Sort of the underappreciated worker in the background of every financial transaction. But while growing the tech platform's influence has been the plan for a while now, we got to see that plan start to move into motion in this quarter. Most of SoFi's business up until now has been B2C, or businesses selling directly to consumers. But with the technology platform, they've diversified into a B2B business, with 30% of new sales for Galileo in the B2B area, and much of that outside the US. So investing in this business is going to be key to SoFi's future for two reasons. One, it diversifies SoFi income away from just consumers, who can be very fickle if you get into a bad PR spot. Just look at what happened to Robinhood. But when you're selling to a business and you have a contract, they're much less likely to cut their spending on services that help run their business, even in a recession. And number two, it sets them up for their long-term plan of controlling the technological infrastructure that will underpin the next generation of financial services. No more waiting 3 to 5 business days to send money, and hopefully no more paper checks. When we put these segments together, we see SoFi's total revenue is up 51% year over year, and their total products sold across all segments is up 69% year over year. This is insane considering SoFi's size and business. Now, I saw some comments saying that SoFi was basically just like any other bank at this point, so I want to compare these earnings to some other banks. Bank of America, earnings grew less than 1% last quarter after dropping more than 10% in their previous 2 quarters. Wells Fargo, down more than 7% after being down 23% and 6% in the last 2 quarters. JP Morgan, earnings are basically flat this quarter and down the last 3 quarters. But hey, maybe it's only the big banks that are struggling. Well, no, Robinhood's earnings are down 43% this quarter and down substantially last quarter too. Though I am filming this around the time they're going to announce some new earnings numbers. But SoFi is clearly the odd one out here. SoFi also raised their guidance for earnings for next quarter, which I'll show on screen now, though I'm not going to read through these in this video. So when you take all these factors together, SoFi's earnings numbers, an improving market, several key catalysts, what do you get? Well, we see a growing SoFi ecosystem of products that keep getting better over time. We see numbers of members and the number of products sold growing rapidly. We also see major catalysts ahead for SoFi that could result in short-term price appreciation in addition to the long-term returns that I expect over the next 5 years. Benjamin Graham, who is Warren Buffett's mentor, said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." And while the market has been voting against SoFi and growth in general for the last several months, the weights are starting to stack up in SoFi's favor. Now, I haven't made any new purchases in SoFi, but it currently makes up up around 7.5% of my overall portfolio with over $10,000 invested. And if you found this video valuable, maybe share it with a friend. Don't forget to subscribe, and I'll see you next time.